Hi, everyone. Thank you for joining us for our May market update. I'm Valerie Leonard, founder of EverThrive Financial Group, and these updates are one way we share important insights about what's going on in the markets and in the economy so that you can make informed decisions about your investments and your financial future. There's some key information I've been using to make decisions on behalf of our clients, and today I'm going to share that with you. Just so you know, this video is being recorded on Monday, May 8th, and the data is all current. Today, we're going to focus on the concept of de-risking. Frankly, I believe that risks have continued to rise recently, and the name of the game for any investor right now is risk management. In fact, a lot of the data points that I'm watching at the moment are signaling the potential for more trouble ahead. Now, this isn't meant to cause concern. I don't want anybody to panic because we're not there. But of course, we're always preparing for both worse than expected and better than expected markets here at EverThrive. So, what's important is making sure that you never take more risk than you're comfortable with. And if you can't stomach future losses, reducing exposure and having a contingency plan in place is extremely important. So let's break down what's happening in the markets, and then we're going to talk more about risk management in a minute. Now, recently, we've seen continued pressure on earnings, and this is in part due to a trend called nearshoring, which is where companies are bringing back production closer to home and closer to the time zones where their customers operate primarily to try and minimize the effects of supply chain disruptions. You may not know that Lego, for instance, recently just broke ground on their first ever US based manufacturing facility. This is one single example of a trend that has continued to pick up speed and is costing companies more, which is cutting into profits. Unfortunately, when you see increases in costs, it can compound the impacts of inflation. Plus, there's the fact that surplus savings from the pandemic are drying up. And so we've seen a flight to bonds with money flowing out of the banking system and into the bond markets, which we will talk more about here in just a minute. In terms of the market performance for the month of April, the S&P 500 gained 1.4%, the Dow Jones Industrial Average increased 2.48%, and the NASDAQ Composite was flat for the month, up just slightly. But the S&P 500 blended earnings decline was 2.2% during the first quarter of 2023. So if this holds, this would mark the second quarter with a year-over-year decline, and we haven't seen that since the third quarter of 2020. Now, average earnings is an economic fundamental that drives long-term market performance, and this is something we are watching closely. The bond markets were all about action in March and April, and fixed income markets experienced positive returns with falling interest rates. So the 10-year US Treasury fell from about 4.01% at the beginning of March to 3.53% last week. And as we talked about earlier, investor demand for higher quality fixed income drove the change. The Bloomberg Aggregate Bond Index gained 3.01% from January 1st of this year through April 27th. And the Bloomberg US Corporate High Yield Index gained 4.28%. So high yield are going to be your riskier companies out there. But bottom line is that there are potentially opportunities in bonds and fixed income, both from a risk mitigation perspective and for potential upside. And in addition to the fact that this may help diversify a portfolio, they've also been beaten up from a price standpoint, which means that there may be more upside potential than traditionally normal in the fixed income space. Now, let's turn our attention to steps that you can take to manage your investment risk. First of all, even an aggressive investor may want to consider increasing bond exposure at the moment, with the caveat that every investor is different, and it's important to discuss what's right for you with our team or a qualified financial advisor. Next up, I've spoken before about the benefits of dollar cost averaging and what that can potentially help you do, particularly when you are looking to increase your risk level and put more money to work in the equity market, or when you're looking to invest cash. So this is a strategy that I'm recommending in those cases. And this strategy helps you put money to work at regular intervals of time and helps you avoid poor market timing that may occur if you were to just put all the money to work all at once. And last of all, I know that you all know that diversification is important, but now is the time to ensure that you're diversified, not just across stocks and bonds and cash and so on, but also across different regions, different sectors, various company sizes, and more. What was a solid diversification strategy last year or even just a few months ago may be leaving you with some risk exposure now. So, in other words, it may be time to consider reallocating your investment portfolio. If you're not certain how much risk you should be taking, our team would like to offer you a customized risk assessment that will help you decide. So, by taking this assessment, you'll be given a risk score on a scale of 1 to 99, and we can help you evaluate whether your investments are in line with your risk number. So think of our risk number sort of like your investment speed limit. It tells us how fast you want to go or how slow you want to go. And it's really important to get the right speed. Okay, so to get your risk assessment, you can either scan the QR code on this slide or you can email us at info@everthrivefinancial.com with the words risk assessment in the subject line. Once we receive your results, we will contact you to follow up with our specific investment recommendations for you. And now for our 401k clients, or really anyone with a 401k plan, it's common to think of a 401k plan as a passive investment account. But now is a good time to take a few action steps to ensure that your plan is on the right track for retirement and for the future that you hopefully envision. If you're concerned, evaluate your risk tolerance and add some fixed income to your portfolio. And like I said, take the risk assessment that I mentioned on the previous slide. If you are earlier in your career, if you have a long-term time horizon and you're okay weathering the market ups and downs and have a more aggressive risk tolerance, my advice is to stay diversified and don't overreact. Don't allow your emotions to dictate your investment decisions. But for everyone, just remember that making emotional decisions is never a good idea when it comes to your investments. Now, here's a follow-up on the recent bank failures, which we went over in our last market update. The initial market reaction was one where investors sought higher quality investments. Riskier assets like stocks and high yield bonds sold off, and higher grade fixed income sectors experienced falling yields and rising prices. So regulators and insurers stepped in. They wanted to ensure that deposits were safe. The Federal Reserve and the U.S. Treasury also made capital available to other banks to reassure investors that the banking system was healthy and also well capitalized. And last, the issues causing Silicon Valley Bank, Signature Bank, First Republic, and even Silvergate to go under seemed contained and not systematic to the other well-capitalized banks. So while the banking sector is undergoing significant change, we expect to continue to see volatility and pressure in this space. We very well may see future bank failures. And I think, that can certainly happen. As I said in my last video, the junk has to work its way out of the system before the market can find its footing. And when I refer to junk, I'm referring to companies with risky assets and questionable balance sheets and profits. And so the banks are worried about their customers and they don't want to see their customers go under. But at the same time, loans are also getting harder to come by, and those that can get a loan are forced to pay higher rates by recent standards. So all said, recent bank failures are a strong reminder that investors do always need a risk management strategy in place. These market risks can appear suddenly and with little warning. So I don't want you to be alarmed by this, and there's certainly no need to panic. As I've said before, on the whole, banks are well capitalized and regulations have been put in place to help keep the banking system liquid since the 2008 financial crisis. We learned a lot from that period of time. So my advice is to be sure to check your FDIC coverage and keep your bank accounts under FDIC limits. With an official recession looking likely to be called in the near future, corporate profits are also in focus right now. So we've seen a large number of companies recently warn investors to lower their earnings expectations. Again, the worst outlook since even before the pandemic in the third quarter of 2019 is basically on the horizon potentially. And the Federal Reserve remains committed to keeping short-term interest rates high. Now, this is good news for savers using higher yield savings accounts, but bad news for anyone with debt or who's looking to take out a loan. Also, we're watching the U.S. labor market. It continues to remain strong, but we did see the highest year-over-year labor cost increase last week. Really, it was the biggest increase we saw since the 1980s. So in the first quarter of this year, unit labor costs were up 6.3% over the same time period last year. Also, for first quarter of this year, GDP came in below consensus, with pending home sales down about 5.2% month over month, with the majority of the hit coming from the Western United States. Now, there is some good news, which is that inflation is down to its lowest level that we've seen in 2 years, down to 5.81%, although there is still a ways to go to reach the Fed's target 2% rate. So, wrapping up, I want to remind you that we are always on your side. We actively manage our investment management clients' portfolios and make changes within their risk tolerance on their behalf. And for our 401k clients, know we're here to advise you on your accounts if you would like. And for those of you who may not yet be our clients, we are happy to talk to you about your investment or 401k management needs, and we will continue to provide these updates as a service to all investors. So be sure to check out our monthly videos. I really look forward to providing you these updates each month, and I have some news for you. I am going to be sharing some quick tips and deep dives and other content via EverThrive's YouTube channel, in addition to these monthly market updates. And the best way to know when a new video is posted is by simply clicking subscribe on the EverThrive Financial Group YouTube page. This is all in the spirit of giving you as much information as possible so you can use it to make informed decisions and thrive in all areas of your life. I'm going to try to keep those videos to 1 to 2 minutes. They're going to be timely topics, things that are going on that you need to know about in order to stay informed. So go subscribe to our YouTube channel. Thank you so much again for joining us. We look forward to connecting with you again soon.